Some call it the best mortgage in Canada. They say it's the most flexible and the most versatile mortgage. I'm talking, of course, about Scotiabank STEP. In this video, we'll go under the hood and see what the fuss is all about. Is it really the best mortgage product? More importantly, is it right for you? Plus, I'll share some exciting news about an upcoming mortgage product that is sure to give Scotiabank STEP a run for its money. That's coming up right now. Victor here, and welcome back to a series of videos that goes behind the scenes of mortgage financing to help Canadians get approved for a mortgage they deserve. If you're new here and want to receive easy to understand mortgage news and tips, please consider subscribing. So let's talk about the Scotia Total Equity Plan, or STEP. Basically, it's a flexible borrowing plan tied to the equity in your home. For example, it lets you mix and match different kinds of products like mortgages, a home equity line of credit, known as a HELOC, and credit cards. There are so many advantages to structuring your mortgage this way. But before we get into that, let me get one thing out of the way. This is not the best mortgage. That would imply it's suitable for everyone, which it definitely is not. It is by no means a one-size-fits-all mortgage. Why do I say that? Well, first of all, if you're looking to purchase a home, you'll need a minimum 20% down payment to qualify. Likewise, if you're looking to refinance, you'll also need a minimum 20% equity in your home. Why is this the case? Well, in Canada, there are limits to how much you can access through a home equity line of credit, or HELOC, secured by your property. A HELOC cannot exceed 65% of the total value of your home, and in combination with your mortgage, the two debts cannot exceed 80% of the market value of your home as determined by your lender. So if you don't meet this minimum criteria, or you need a high ratio mortgage, don't worry, there are other mortgage products more suitable for your needs. Now that we got this out of the way, let's take a closer look on how STEP works. As mentioned, STEP allows you to borrow up to 80% of your home's value. Scotia calls this the global limit. Unlike a traditional mortgage, you can divide your mortgage into different terms and rates. This means that you can choose a fixed rate mortgage for one portion of your loan and a variable rate for the other portion. That's kind of a neat feature. So if you're having a hard time deciding between fixed or variable, no problem. Now you can choose both. You can enjoy the predictability that a fixed rate mortgage provides and take advantage of a lower interest rate with a variable rate mortgage. Also, remember I said you can combine other products into STEP, such as a home equity line of credit or HELOC? Well, this is where STEP really shines. By adding a HELOC to the mix, as you pay down your mortgage, you can access more and more equity in your home. Consider this example. To keep it simple, let's say your home is valued at $625,000. Yes, I know, you can't buy much with $625,000 in Toronto, but we're using this just to keep the math simple. Okay, so let's also say you have a $500,000 mortgage and a HELOC with a zero balance. Let's assume a fixed rate of 2% amortized over 25 years. As you make your monthly payments, the principal portion of your payments gets converted to the HELOC portion. So by year 5, you will have paid down the mortgage by $81,000. And that entire amount would have been converted to a HELOC. In fact, during the entire life of your mortgage, with every payment you make, equity in your home is automatically transferred to your HELOC, up to 65% of the global limit. But you might be asking, why would you want to do that? That's a great question. According to the Scotia STEP calculator, it can help you achieve future goals, such as renovate your home, buy an investment property, or consolidate higher interest debt. Technically, you're borrowing back your equity to achieve these goals. But never mind that for now. The real power is how it helps you pay off your mortgage faster, saving you thousands of dollars in interest. Allow me to explain. With traditional mortgages, There are various strategies to pay off a mortgage faster. You can increase the payment, pay bi-weekly, and also make lump sum prepayments annually, which is usually up to 15 to 20% of the original principal amount. The problem is that you lose liquidity. Any extra payments you make is no longer easily accessible, if at all. So, if there was a sudden urgent need for cash, or for any emergency, you would need to refinance, get a home equity loan, or sell the home to access your money. Even worse, if your emergency is due to a job loss or loss of income, you may not be able to refinance your home at all. And it's this "what if I need my cash" scenario that prevents many homeowners from fully utilizing options to pay their mortgage off faster. Instead, the cash sits in a savings account earning about 1% a year. That 1%, by the way, doesn't even keep up with inflation. Inflation just hit a new 18-year high of 4.7%. So if you're only earning 1% interest, the value of your money actually decreases over time while sitting in a savings account. So what do you do with your extra savings? Put it towards the mortgage or save it? Well, Stepp solves this "what if an emergency" scenario. You can go ahead and make extra payments towards your mortgage, knowing that your funds become immediately accessible through the HELOC. In the meantime, you'll be saving hundreds or thousands of dollars in interest. Let's go back to our original example of the $500,000 mortgage. What if you had an extra $25,000 a year? That's only 5% of the original mortgage amount, which is less than the 15% prepayment privilege. So what can you do with it? Well, let's look at how using the $25,000 per year to pay down your mortgage can result in significant savings. To compare, let's first see how much interest you would pay if you didn't use the annual prepayment privileges. Let's plug these figures into the mortgage calculator on the Government of Canada website. Using the same assumptions as before, over the span of 25 years with no prepayments, you will have paid about $135,000 in interest. Instead, if we go ahead and pay down the mortgage every year with that extra $25,000, then here's the result. You pay off your mortgage in just over 11 years. That's 14 years sooner. Your total interest paid would be $60,000. That's a savings of $75,000 in interest. And remember, with the mortgage now fully paid up, you can still access your money at any time, indefinitely, sitting as equity in your home. How much can you access? As stated before, the HELOC component is maxed at 65% of the original value of your home. In our example, since the home was originally $625,000, the max HELOC would now be 65% of $625,000 or $406,250. This could be your rainy day fund, or use it to buy an investment property, or for whatever other purpose. I know, some of you will ask, what if we invest the $25,000 instead? Or what if we pay down the mortgage and then immediately withdraw it for an investment? That's called the Smith maneuver. And while it's definitely possible to do with a Stepp, it's beyond the scope of this discussion, so we'll leave that for another video. As you can see, there are many advantages to using the Stepp program. If you're purchasing a new home, it may give you the flexibility to pay your mortgage off faster. Or perhaps you already have a mortgage. You can refinance or switch with additional funds into a Stepp program. The additional funds can be used right away to consolidate debt or do home renovations that you've been putting off for some time. So that's the good stuff. What are the downsides to Stepp? There are a few, which is why it's not for everyone, and why you need to understand your situation well before jumping in. And it also validates the fact that you should consult a mortgage broker. Yes, you can get the Stepp directly from the bank, but a mortgage broker will offer unbiased advice and determine its suitability for you. As well, did you know we have access to unpublished discount rates? You get our discount rates without the need to haggle or the stress of dealing with the bank. And by the way, our service is free to you, so why not take advantage of it? Anyway, I digress. Back to the downsides of STEP. Number 1, as previously mentioned, you need a minimum 20% down payment or equity in your home to take advantage of the HELOC component. By the way, all Canadian banks are regulated to have this rule. It's not just a Scotiabank requirement. Number 2, STEP is a collateral mortgage. This means that Scotia will register a mortgage on your property that is greater than what you're actually borrowing. This is typically 125% of your appraised home value. The banks will tell you that this allows you to increase your credit limit later without incurring legal fees. While this is true, it can also make it more expensive to switch lenders at maturity. A collateral mortgage will limit your options if you decide to switch lenders later. That's because collateral charges don't qualify for free switches at most lenders, unlike traditional mortgages. You'll most likely be forced to refinance the whole mortgage should you decide to switch lenders down the road. But if you're in it for the long haul, it may not really be an issue. Number 3, a collateral mortgage prevents you from obtaining a secondary financing from another lender should you need extra money down the road. So, for example, it would be very difficult to get a private second mortgage. That's because all your home equity is tied up, even if the value of your house increases. Remember, a 125% mortgage charge is placed on your property even though you owe much less. Plus, Scotiabank does not allow secondary financing. Number 4, the minimum payment on the HELOC portion is the interest. STEP is intended for borrowers who can manage their finances well and are disciplined in using credit. If all you pay every month is the interest, then you'll never lower the principal amount owing. If you tend to max out your credit cards and lines of credit, then STEP might not be suitable for you. And number 5, the HELOC portion of STEP is a variable rate based on prime. Because the rate can go up, so can your monthly payments. That's why STEP is more suitable for borrowers with extra disposable income. Okay. After considering both the pros and cons, is STEP right for you? Let me know what you think in the comments section below. Alright, time for some exciting news. It's about a mortgage product that is sure to give Scotiabank STEP a run for its money. So here it is. On October 5th, 2021, TD Canada Trust announced that they are making their home equity FlexLine available through mortgage brokers. The launch of this product is expected to be January 10th, 2022. FlexLine is very similar to STEP, but what's exciting about it is that now you'll have more competitive options when working with a mortgage broker. I'll be making another video as more details become available, so stay tuned for that. Navigating all these mortgage rules can be complicated, but I'm here to help. Book your free discovery call and we'll figure it out together. Contact details are in the description below. Thank you for watching, and don't forget to subscribe. Have a great day, and I'll see you next time.